So, a key theme running through this material seems to be the bullish high energy analysis report focused on Hycroft Mining Holding Corp., specifically arguing that the recent 50% price explosion is just the start of a major short squeeze.
It's fascinating. You have this explosive momentum. And for a sophisticated investor who really needs to understand the mechanics, we should probably dive right into how to anchor that energy in, hard data. Make this analysis report truly bulletproof.
Let's start with that short squeeze thesis. It's really the emotional and, I guess, the mechanical core of this piece.
It is.
And the material makes a strong case for high momentum. It highlights the 60 million plus shares traded. That's a rotation of pretty much the entire float.
And it correctly notes the shorts are underwater.
Exactly.
But while the analysis report effectively establishes that high trading volume and price action, the core short squeeze thesis, it relies a little too heavily on circumstantial evidence. It really needs to be supported by essential quantitative short data.
Right. Momentum is great, but a squeeze is a verifiable mechanical event.
That's the key.
I agree. I mean, without quantifying the short interest as a percentage of the float, or even just calculating the days to cover, the claim that this is textbook squeeze territory just remains a narrative. It's not analytically robust.
And the weakness there is that by focusing purely on price action and the emotional stress of short sellers, the report misses a huge opportunity.
The opportunity to establish the precise conditions, the specific metrics that really determine how severe a squeeze could be.
Exactly. So the suggestion for improvement is critical here. We need to integrate the specific metrics of the short position. We have to transform this narrative from just circumstantial momentum into a statistically supported analysis.
And that gives a listener a much stronger foundation for the investment thesis.
A much stronger one.
So what are some concrete ways to weave those metrics in? Because, given the rapid pace of the market, the official short data is often lagging by 2 or 3 weeks?
It is. So how do we incorporate that old data without misleading people about the current pressure?
Yeah.
Well, we need immediate clarity, even if that requires some calculated estimates. First, you have to clearly state the most recently available official short interest figure.
Expressed as a percentage of the float.
Right, as a percentage of the float, right at the top of the short squeeze thesis section. But you can't just stop there.
And how do you constructively use the volume data? Because if we use the average daily volume from before this 50% spike, the days to cover number is going to look astronomical.
It'll look huge, yeah. It would suggest a squeeze that might not actually exist now that volume is surging.
So that's the subtlety we need to address.
It is. The report should calculate and explicitly include the estimated days to cover based on the recent surge in volume, not the lagging 30-day average.
So you take the known short interest number.
You take that known number and you contrast it with the massive volume of the last, say, 3 to 5 trading days. The key is just being transparent.
Okay, so you define the parameters you're using.
Thirdly, you say, based on the currently reported short interest of X shares and the last 3 days of 20M plus average volume, the DTC is only 0.Y days.
That's powerful. It shifts the discussion from shorts are underwater to shorts cannot physically cover their positions without triggering more buying pressure.
It turns sentiment into a verifiable supply chain constraint argument.
And it offers a pathway forward, really regardless of what the official numbers end up saying.
And crucially, if the official data comes out and confirms the short interest is actually quite low, let's say under 10% of the float, the report needs to adjust its focus.
So less emphasis on the aggressive squeeze headline.
And more focus on the rapid institutional accumulation that followed the positive fundamental news.
That's a crucial intellectual pivot. You maintain the bullish sentiment, but you shift the mechanical driver. It becomes about long-term conviction from large buyers, which is just a much more robust analytical position.
Precisely. So now that we've confirmed the squeeze thesis needs quantification, let's talk about the underlying justification. Because if the shorts don't cover, the fundamentals have to justify this new price.
That's a smooth transition. The report does highlight 2 massive fundamental catalysts, the Vortex Silver System discovery and the debt-free Fortress balance sheet.
And those are the right drivers.
They are. But the analysis is kind of missing the link between the qualitative change and the quantitative reaction.
You've hit the nail on the head. The report identifies the correct fundamental catalysts for the repricing, the high-grade silver and the debt wipeout. But it needs to quantify precisely how these facts justify a 50% market reaction, an $8.10 move per share.
The weakness is that it doesn't include any specifics, not on the grade like ounces per ton or the potential resource increase, or even the specific cost savings.
So a sophisticated investor can't model why $16 was the wrong price and 24 is the right starting point.
It feels more like general optimism than a justified repricing.
So the suggestion for improvement here is to anchor the discussion of the vortex discovery and the balance sheet in hard, specific comparative data.
Something that demonstrates the scale of the value change.
Exactly. It shifts the argument from that general optimism to a specific, justified repricing based on measurable operational improvements.
Okay, let's focus on the Vortex Silver system for a second. For listeners maybe less familiar with mining ops, why does a high-grade silver intercept justify a 50% stock price move? How do we bridge that gap between more silver and more profits?
Well, that's the core economic implication, isn't it? In mining, the difference between low-grade and high-grade silver is, it's the difference between scraping by and printing money.
Okay.
High-grade means significantly more ounces of metal are recovered per ton of rock you mine. This drastically reduces the unit cost of production.
Because you're processing less waste material.
Far less. So if the analysis just cites the specific high-grade numbers the company released, ounces per ton, for example, and then compares them to the mine's previously accepted averages, it instantly demonstrates that the entire project's margin profile has fundamentally changed.
And that justifies the repricing. Citing the numbers provides the economic evidence of a lower cost structure.
Which translates directly into higher potential future earnings.
Right. So let's talk about the valuation framework. What if the specific drill data is proprietary or just lagging? How should the report support its new valuation targets then?
Then you frame the argument using enterprise value. You suggest a reasonable range of implied value per ounce based on industry comps, and you show how the new resource estimates, even if they're preliminary, move the target valuation well beyond the current price.
You mentioned enterprise value, or EV. Why is that the superior metric to use here, especially now that the company is debt-free?
Well, EV is calculated as market cap plus total debt minus cash. For a mining company that just eliminated its debt, creating what the report correctly calls a debt-free fortress, EV becomes incredibly clean.
Right, it's just the value of the operating assets.
Exactly, without any capital structure noise. And by using EV per ounce of resource, you can easily compare the company to its debt-laden or cash-rich peers. It immediately justifies the new valuation based on industry multiples.
So that's a strong, quantitative way to address the discovery and the balance sheet at the same time.
It is.
And speaking of that debt-free fortress, eliminating the threat of bankruptcy is huge. But how do we quantify that for the investor beyond just, qualitative relief?
You make it about future profits and viability. When discussing the debt-free fortress, the report needs to clearly state the exact amount of debt that was wiped out, the dollar figure.
And then articulate the savings.
And then briefly articulate the corresponding annual savings in interest payments. This demonstrates a direct, measurable, positive impact on future cash flow and earnings. It grounds the fundamental shift in verifiable economics that someone can carry forward into their own financial models.
It proves the company is now self-sustaining.
That's the point.
Excellent. Okay, this comprehensive quantitative layer supports the entire bullish thesis. Now let's pivot to risk. The technical analysis section is fantastic for establishing support levels, defining the $20 hold, and setting those blue sky targets of $30 and $35.
I can see what you're going for here. The technical analysis section is excellent for establishing breakout and support levels, but its exclusive focus on the bullish case, well, it risks overlooking some critical counter-arguments and limitations.
Right. The argument is basically that the bulls are in total control. But that approach, while it's great for a momentum thesis, it fails to consider the most immediate downside risks.
And these are risks arising precisely from the company's newfound strength.
Yeah, the lack of proactive risk assessment, especially around dilution or institutional profit-taking, it weakens the overall strategic value of the analysis.
It does. And the suggestion for improvement here is vital. Introduce a brief, high-impact discussion on the potential limitations, the counter-arguments that could derail this momentum.
So position the material as a balanced and rigorous analysis, not purely promotional.
Exactly.
But isn't the author's intent to be purely bullish here? Doesn't including dilution risk sort of undermine the high-energy tone they were going for? Doesn't it provide an out for the thesis?
On the contrary, ignoring a known, imminent risk that's associated with corporate strength actually damages credibility with a sophisticated audience.
That's a good point.
We want to position this as intellectually rigorous, and the number one strategic risk that needs to be addressed immediately, given the surge and the debt-free status, is the risk of dilution.
So introduce the risk of dilution. Given the stock surge, management is in the strongest possible position to issue new shares to raise capital, what we call selling into strength. How should the report frame this?
It should include a dedicated paragraph analyzing the immediate risk that management may authorize an at-the-market offering, an ATM.
Right, and while issuing new shares is good for the company long-term, it solidifies the cash position for exploration. It could severely dampen short-term price momentum by increasing the share count.
So the report needs to analyze the probability of that move.
And state that if an ATM is announced, that $35 target would immediately need reevaluation because of the increased float.
That anticipates a very real strategic headwind. It gives the investor an essential warning sign. What about beyond the company's actions? What about the profit takers who drove that 60 million share volume?
We need to acknowledge that institutional pressure. That 50% rise may trigger massive profit-taking from early institutional investors or long-term holders, people who are just cashing out huge gains. So how can the report incorporate that behavioral element into the technical analysis without sounding, overly cautious?
You suggest watching the price action in the, say, $26 range, not just defining it as technical resistance on a chart, but explicitly naming it as a potential supply zone.
A supply zone where major institutional selling is likely to occur.
Right. This integrates behavioral finance, the urge to monetize profits at a round, high number, into the technical outlook. It makes the analysis much deeper than just lines on a chart.
And building on that point, does the report need to explore a scenario that isn't an immediate blue sky breakout to $35?
It absolutely should. For a complete picture, you have to explore an alternative conclusion. Acknowledge the scenario where the immediate buying interest just fades after the initial short covering.
Which could lead to consolidation.
Or a healthy, measured pullback toward the $22 support level, rather than an immediate vertical climb. Providing that more cautious, intermediate outlook alongside the aggressive targets just provides intellectual credibility. It helps the listener manage their expectations.
It proves the analysis is robust, not just hopeful. This has been a great exploration of how to refine a high-energy, successful analysis report.